Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. Today was an incredibly interesting day. I did not put out a video yesterday, but I was loud on Twitter talking about bears being way too aggressive and that the market was set to rally. Today, CPI data came out showing strong and persistent inflation. Immediate release of the CPI data had the market completely recoil back, dropping the S&P 500 below $350. Now, it needs no repeating that I am bearish on the market and continue to be so. I believe that markets are to continue their bearish trend lower and lower, possibly well into summer of next year, but as I have been saying yesterday, I think investors are not ready to cope with this reality, not yet, and today's market pump was a result of that. You have to always account for market sentiment and the stubbornness of investors when pricing and how much we are likely to move in certain timeframes. This is the same thing we have seen since the beginning of the year where bad news are met with market rallies. Of course, they don't make any sense at all when we look at the bigger picture of things and are fully aware of the recession we are in and its very many implications, but we are far and few while the market is filled up with people who easily fall into the narrative that things are not good, but not too bad either. As such, you get these weird rallies that leave a lot of question marks, but in the end, it's just the market adjusting to the rapid changes that are happening. It's all very cyclical. We begin with a CPI report that is met with an immediate sell-off. Then over the course of weeks, the corporate media works hard to misinform individuals that we are not in a recession and that regardless of all the bad metrics that came out, we are still somewhat doing good, and then they will point to whatever cherry-picked data their underpaid intern could come up with. Investors all over the world eat it up and become conflicted over common sense versus manipulated narratives and decide to buy the dip, as the saying goes, since in the end, they are still under the false assumption that stocks can only go up. The thing is, as much as we have fallen, we are still way overvalued and need to be reeled back in to meet correction valuation with price. As such, investors buy the dip, but over the course of time, they become uncertain as more and more people pull out of markets. With an unsustainable market, everyone starts selling little by little, which is how you begin to see weakness in the bull runs until they pull the plug and boom, you get a dump. Then you add Jerome Powell speeches which add uncertainty and volatility, you add higher rates in the future and company earnings being projected as smaller. Sprinkle in layoffs and huge uncertainty in Europe and China with the cherry on top being nuclear war talks, and you get markets being forced back. And then the cycle begins, and so on and on and on. I mean, you tell me in the comments, is this not what we have seen over and over and over since the year started? You will see the tech analysis say this is pure market manipulation and that this makes no sense since metrics like IV or the VIX do not align with the consistency of the price run, but these things just prove to me that the majority of people don't know what they are talking about because they are ignoring the real fundamentals behind big market movements. Lucky for me, we day traders in our Discord alerted to SPY calls in the very morning right before market opened, and we came out swinging heavy with gains unlike those we have seen before. Heavy shout out to my audience in Discord who are also tuning into my videos. Now, let's break down what exactly was in the CPI report to see where our economy is standing. Ahead of time, we are going to go deep into this report and talk numbers, and I am going to speculate and give you tons of wrinkles, so it will not be an easy breezy type of video. The price that consumers paid for a wide variety of goods and services rose more than expected by 0.4% for the month of September. This was more than some of the estimates that were put out by analysts, with the Dow Jones coming into mind with a 0.3% forecast. On the 12-month basis, inflation was up 8.2%, which is off of its peak around 9% back in June. If we exclude food and energy prices, core CPI was even higher for the month of September, accelerating a scarily 0.6% against the Dow Jones estimate for a 0.4% increase. As you might imagine, the trading algorithms of Wall Street apparently hit automatic sell on because markets literally tanked down below $150 for SPY once the news came out. Economists and analysts all sort of came intro agreement to excuse the stock bounce we saw to be understood as acceptable under the belied and faith that they have stored on the Fed. They argued that the Federal Reserve has made it very clear they are committed to price stability and to reducing inflationary pressures. As chief economists as MasterCard said, Michelle Meyer said, the more inflation comes in above expectations, the more they are going to have to prove that commitment, which means higher interest rates and cooling in the underlying economy. Now, I want to hyper-focus today on the food part of the inflation report. We have talked to death, real estate and housing, and we have gone to great lengths to discuss energy. A large jump in food prices boosted today's headline number, as the food index rose 0.8% for the month, which was the same as August, and was up 11.2% from a year ago. This increase helped offset the 2.1% decline in energy prices. A lot of people have been asking, why does food prices keep on growing? It makes sense that energy does due to Europe's position in real estate because it's in a bubble, but why food? Everything from meat to cereal and fruits and vegetables has become more expensive. Food prices at restaurants also climbed 0.9% from the month before, while food at home increased 0.7%, and the reasons range and are more complex than you would think. Increased gas prices and labor shortages are driving costs for businesses. We also have to acknowledge that Ukraine has disrupted exports of wheat, sunflower oil, and other produce. This has strained global food supply and pushed prices to new highs. You might hate me for talking about climate if you are one of those that think it's a conspiracy, but the truth is that climate-related issues have been reported and noted by companies themselves as being the #1 factor in lowered crop yields. One prime example that comes to mind is the recent drought in the western portion of the United States. So spikes in costs due to labor, the production disruptions we are seeing across the globe, the transportation demands that are not being met, and of course the global conflict we have seen happen is affecting every aspect of the economy, which includes food. Believe it or not, food actually did not begin to spike this year, it actually began to move up when the pandemic began because of high demand. Food prices began to rise as people stocked up on food from the grocery stores. Remember all those people hoarding in toilet paper and Dorito bags? Yeah, those are the ones we should be pointing fingers at out of panic. Restaurants, as a result, also began to jack up prices as businesses reopened and consumers began to dine out again. However, prices never cooled off because even as businesses opened up, supply constraints still remained, even to this date. So we are in this place in time where prices are high on both sides and then you cannot even meet the supply needs. These supply chain disruptions can be attributed to multiple factors. For once, increased gas prices made it more expensive for farmers and retail to transport food products around countries. Worker shortages have resulted in businesses paying more for labor. Farmers are also facing higher costs of operation for things like fertilizers. Costs are rising everywhere in the supply chain, and these increases are being passed down to us. A lot of people think too simple of the conflict in Ukraine. Like I said earlier, Ukraine is a major exporter of wheat, sunflower oil, and other products, but Russia too has had their hand in helping drive food prices up. They have blocked agricultural shipments from leaving the Black Sea region. And lastly, climate-related issues have hit the food supply. Summer crops like tomatoes and onions have withered, while greens grown in the winter are now at risk of being impacted. With less food on the markets, prices could continue to move up. Food is an incredibly complex issue that many people undermine in importance, and its impact on the CPI and the overall performance on the future of the economy is primordial. There are a lot of risks and possibilities where food supplies could further deteriorate, and we could face very serious ramifications because of it, so make sure you stay well informed as to how things move. Back to the CPI data, energy prices moved higher in October. Shelter costs, which make about 1/3 of the CPI, rose 0.7% and are up 6.6% from a year ago. Transportation services have shown a big bump, increasing 1.9% on the month and 14.6% on the annual basis. Medical care services also rose 1% in September. We have seen the Fed raise benchmark interest rates 3 full percentage points since the month of March of this year, but with today's data, the possibility of them increasing them in the future is almost all but certain. For sure, I am certain that we will see a fourth consecutive 0.75 percentage point hike when the Fed meets in November. 98% of the market believes this will be the move. I was going to publish a small segment on housing, but that is better saved for later. Right now, I want to talk about the world's most trusted investment bank and financial services, Credit Suisse. A new report by Bloomberg showed that the infamous bank may face an $8 billion capital shortfall in 2024. This underscores the challenges that the troubled lenders face in the future. They are facing a hole of 4 billion francs and now have to deal with cyclical and structural challenges. The firm is reported as exploring radical cuts to its volatile investment banks, including spinning off large parts and fiving off its securitized products group. While raising capital is one option under consideration, Credit Suisse executives would prefer not to issue equity with the share price near record lows. The needs to stay alive and functional for Credit Suisse are simple. They need to build about 9 billion Swiss francs of capital in the next 2 to 3 years. Given the dilutive nature of a capital increase, they are expected to prioritize asset disposal. Bidders are lining up for the bank's securitized products unit, which is a key pillar in the downsizing of its investment banking operations. The bank is also considering bringing in an outside investor to take a partial stake and inject money into a spin-off of its advisory and investment bank businesses. Credit Suisse has also said they are working on possible asset and business sales as part of the plan. Their stock price has dropped from a pandemic-era high of $12.30 to under $4 today, which is a major sign that they are treading on perilous waters. One wrong move and they are out and under. In case you need a quick review of what led them to be in the hot water they are in, Credit Suisse was involved in the Archegos Capital scandal. They were charged with being involved in a huge money laundering scheme with cocaine trafficking gangs. They had a huge information leak detailing that over 30,000 customer accounts holding a collective amount of more than 100 billion Swiss francs were compromised. On top of that, following the Ukraine invasion, Switzerland placed sanctions on Russia. In response, Credit Suisse requested hedge funds and other investors to destroy all documents that linked Russian oligarchs to things like loans, leading to probes into the bank's compliance with sanction requirements. They were invested in Greensill Capital and had exposure of more than $10 billion in the company's products. In March of 2021, Greensill Capital failed, causing Credit Suisse's clients to lose as much as $3 billion on their investments. As you can see, not only are they criminal scum, but they are also pretty bad ones at that too. Credit Suisse's reputation is shattered and, in my opinion, unless they can turn business around and hit a lottery jackpot, it will only be a matter of time before they go bankrupt and out of business. Anyone with common sense would not make dealings with a bank like this unless they were 100% certain they wanted to lose money. And that's about everything I have for you guys today. It was a massive day for the stock market after SPY rallied upwards of 3%. My Discord made huge amounts of money trading calls today, and I highly encourage you guys to come over the Discord and join us already. Feel free to tag me in a comment if you have any questions. Thank you for watching my video in its entirety and hope to see you on the next one, to the moon.